frequently featured in the media, including the Wall Street Journal, New York Times, The Economist, Investors Business Daily, Bloomberg, BusinessWeek, Forbes, Barrons and Money, amongst others. So Roni has around 28,000 citations and more than 30 papers in the top 3 journals. And in my view, he's one of the all-time great finance academics. So on a personal level, I first met Roni at a conference in Prague in 2014, but it's not the first time that I'd seen him. You know, given his stature, he's given many keynotes previously, and he's a regular keynote speaker at big conferences around the world. And many keynote speakers I see at conferences, I actually never see them around the conference. I just give their keynote speech and then they disappear. And with others, you know, sometimes I'll hang around the conference, but they just talk about work. What I really loved about Roni is he's actually a fun guy. So he came down to the bar, we watched the World Cup, and we had a great time. So Roni is a very engaging speaker, and I'm very much looking forward to his talk on mutual fund strategic voting on environmental and social issues. I think it's a topic that fits in very well with the corporate governance theme of the conference. And thank you, Roni, for agreeing to give this talk, and the floor is yours. So actually, one more thing before I hand over, sorry. We're going to do Q&A again via the, so please ask your questions via the Q&A, and then we'll take those questions later. Thank you, Roni.
Thank you very much, Philip, for the very nice introduction. I'm going to look for, you know, somehow my slides are right. They're not being shared now, right?
No, not yet.
Okay. Here they are. Okay, sorry. Okay, so thanks for Philip for inviting me to give this keynote speech. This is the first time that I give a keynote speech where on the slide it's written April 21st while I'm in New York. So for me now it's April 20th. So that's a new experience. I wish this conference would have been in person, but maybe at different times. I would have loved to come again to Melbourne and really to sort of to interact with all of you. And, you know, as far as I'm concerned, we can try to do this session as interactive as possible. If you have questions, please write them, and, you know, sort of Philip will moderate the questions, whether sort of during the talk or at the end of the talk. But really, I mean, like any question that you have, any challenge that you have on what I'm going to say, and there are many challenges, believe me, I'm more than happy to entertain. It's sort of, I didn't know exactly how to title this talk, because I'm going to talk about greenwashing and strategic voting in the second part of the talk, but I thought maybe it will be informative and appropriate to put first thing in a little bit in sort of in a wider frame. And I'm really going to talk about an issue that is now probably the hottest issue in corporate finance or in governance, which really what should be the role of firm and investors vis-a-vis the environment and social. You know, what is the purpose of the firm and what are the roles of investors and the intermediaries like funds in terms of not just maximizing profit, but should they do a little bit more than that? And this is, of course, highly controversial issue that we just sort of starting to explore. And I'm going to start from the sort of the basic view, which attribute to Milton Friedman, maybe even earlier, that firms should simply maximize their value. Now, of course, we know from practice and from 50 or 60 years of research that this is not as simple as it sounds, because you have a lot of potential conflict of interest, and you have to think about incentives and compensation and asymmetric information, et cetera, et cetera. So while creating a framework where you maximize the value may not be as trivial, at least the objective is clear. We want to maximize value. Okay, and suddenly here, we're talking about a shift in paradigm. We're saying, you know, it's not clear that we want to maximize value. In fact, it's not even clear that we're trying to maximize the welfare of shareholders. right? Because many of the people on sort of on the other side that are sort of pushing this very important agenda forward, saying, no, we also have to take into account what's good for society, which I have a lot of sympathy to, but it's really, really complicated. That this is just a demonstration, don't take the graph literally, of saying, you know, that firms should maximize shareholder welfare, maybe even not society, and not only shareholder, not even only employees or other stakeholders, but really society as a whole. And that's become, of course, much more complicated. Now, you know, several people, you know, sort of neoclassical economists in particular, and some others actually will say, you know, there is actually no contradiction. Firm action can both improve welfare along the ES, the environment and social dimension, and at the same time maximize value. If this is the case, then we're really, there's no reason for this talk or for all this research, because if I can do the right thing socially or in terms of the environment and maximize value, firm will just do it. Manager will just do it. Shareholder will be happy to do it, right? Because that's really increasing NPV and no one is giving anything away. But in my opinion, this is not likely to be the case. It's, you know, sort of oftentimes reducing the environmental damage or improving social aspects is something that is coming at a cost. And when it's coming at a cost, suddenly things are becoming a little bit more complicated. It's not clear that this is what manager would like to do. It's not clear that this is what shareholders would like to do. I just tell you that I did a small informal experiment in my class by asking students how many of them are willing to give up 120 basis points a year on their portfolio return so that their company will invest more, with more conscious, be more conscious about the environment. And you know, these were finance students, so maybe it's not surprising, but the majority were not willing to do it. And even if they are willing to do it, then there will be the arbitrageurs that will say, you know, this company, ExxonMobil, may not do good for society, but it's relative to its cash flows, it's selling at a low price. Let us buy it and either increase its value or maybe make it private or just enjoy the cash flows at a very low valuation. So it's really much more complicated than just sort of saying, you know, sort of if we maximize NPV, we can also maximize sort of some of the social environmental aspects. In other words, firm needs some nudging to act responsibly in sort of many cases, and where this nudging can come from. So first, and maybe first and foremost, that's already depend on your opinion, it can come from consumers. Okay, this is an example of BP. It can come, you know, here it's about demonstration, but it's not only about demonstration, it's really saying, you know, we are going to buy a product of Patagonia because Patagonia is cares more about the environment than we're going to buy a Nike, for example, that maybe care less about the environment. So that's one way that actually consumer, and we see it especially actually with the Gen Z, that consumer actually have an impact on how the companies are behaving. And notice, by the way, that this action of consumer can be put into a true NPV framework, right? Because if consumer, in my example, don't want to buy Nike because Nike, let's say, is not treating its worker in Thailand in an appropriate way, then they have incentive to change how they treat the worker in Thailand, because otherwise people will not buy their shoes or their clothes. The second, and I think still now, given the urgency of the issue, the most important one is really the government. Okay, the government has many ways in which it can act. It can act through tax policy, it can act through subsidies. It's not only taxing carbon, but actually giving subsidies to green energy, for example. You know, it can be what, you know, financial transfer payment. It can be, you know, new regulation about disclosure, like what the SEC 2 weeks ago 3 weeks ago, actually came out with proposal for new regulation and new disclosure by companies about sort of how much they pollute the environment on several aspects, not only them, but actually the whole supply chain. It can be something that will come maybe from Congress or from Senate, and it also can be something that can come from courts. You see here, this is a very famous case from last June, I believe, where the High Court in the Netherlands actually forced Royal Dutch to pledge to cut greenhouse emission much more than what it originally meant. And such court order is not only applied to Royal Dutch, because then every company in the EU may change its policy because of that. So that's also something I put under the government action. And the one that is perhaps more relevant for us, or most relevant for us as finance people, are action that can be taken by shareholders. And we see it, I'll show you actually from even yesterday, Economist, an article about that. So the first aspect of how they can change, shareholder can change the policy, is really behind the scene action. You can think about, whether it's Carl Icahn that is now suddenly got involved also in the social and environmental issues, are trying to impact McDonald's policy with both behind the scene and what I call number two, which is not so much behind the scenes. So he's not doing it with demonstration, but he's doing it by publicly trying to shame them and to promise negative consequences if they don't do what he thinks should be done in terms of the sort of environment and actually animal treatment. The third aspect is also something that is known in finance, which is the threat of exit. Okay, so maybe it's going to be less effective if you and I individually will do it, but it's much more effective if BlackRock or Fidelity or Vanguard or the pension fund of New York will try to do it and say, look, if you are not even adhere to your commitment about gas emission, then we're basically going to sell your stocks, or we're not going to buy your stocks, etc. And fourth, and this is going to be the topic of the second part of this talk, is really the issue of votes. Okay, investor pile pressure on companies over ESG at annual meeting. This is from the FT, but this is from yesterday, actually, Economist, saying annual meetings are the new frontline in the battle over corporate purpose, which how we started this talk. Basically, climate, race, inequality are on the agenda. And this chart just shows you the actually very significant increase. In the left side, you see the increase in terms of the proposal, and on the right side, increase not only in terms of the proposal, but also the increase in terms of the proposal that actually are voted and pending and passed. So we see that there is some movement, very small, by the way. Still, if you talk about, even in 2021, 450 cases altogether for over 4,000 companies. It's not even one proposal per company. So it's not like, watershed events, yeah. But it's happening. Okay, so a watershed event that did happen is with ExxonMobil, where a company named activist fund named Engine Number One actually was able to force 2 new directors at ExxonMobil with the help of BlackRock. The reason why BlackRock, in a very exceptional way, did not side with management, but side with Engine Number One, is because Engine Number One was amazingly smart in terms of the publicity that it was able to gain to its vote. And many of the shareholders of BlackRock put tremendous amount of pressure on BlackRock to vote with them. And indeed, they have 2 seats now on the vote on the board of ExxonMobil, which they intend to use also to improve its environmental conduct. But who really are those institutions that can do that? So the giant ones are BlackRock that we all heard about with over $9 trillion under management, Vanguard, second largest with $7 trillion. And then you have also on the other side, the more environmental conscious funds like Calvert is a good example, which is relatively big in terms of being an ES fund, environmental social fund, but you see the difference in size, right? This is relatively big with $22 billion relative to $9 trillion. It's really still dwarfing in sort of in comparison. So, so just to sort of quickly summarize, basically, within the action of institutional investor, there are at least 3 possibilities. Okay, what they can do, the BlackRock or the Vanguard or Calvert, they can choose firm with better ES scores. Okay, in fact, we have a paper that I'm not going to present today that show that at the margin, that's exactly what the ES funds are doing. Okay, they choose firm that at the margin are better in terms of the ES, the environmental social scores. Okay, regardless exactly of which score that we're using. And that's relatively easy. And by the way, some people can even say, maybe they should choose actually the biggest violators and change the behavior, which bring it to the second point. Okay, which do they have positive impact on firm environmental social behavior? And the answer that we find is, and not only us, is that the impact that they have is anywhere between 0 to very, very minimal, or sort of not statistically significant. So there is no evidence of positive impact, which is kind of worrisome, bringing back to the point that we, in my opinion, sort of some government intervention is just inevitable if we want to be able to achieve the goals that scientists argue that we have to achieve if we want to prevent some disastrous outcome. The third issue is really that many of those funds, and by the way, companies themselves as well, are doing what we call greenwashing. Okay, they talk the talk, but they do not walk the walk. So they're saying they're doing it, they're saying that they are reducing carbon emission, but it's very difficult to measure whether they do it or not. Okay, so it's not clear that they're doing it. They're saying that for every ton of carbon, they're going to plant whatever, 180 trees in the Amazonas, but there is, so far, there is no mechanism to really verify that this is what they have done. And what I'm going to present here is actually a more sophisticated kind of possible greenwash, and this is in terms of their votes. And what I'm going to show you that they are voting strategically in a way that I think is akin to very sophisticated, clever sort of greenwashing. And this part of the talk is based on a paper that I have together with Guillaume Ordonez Khalifi and Silvina Rubio. Both of them are from the University of Bristol. Sort of basically looking at mutual fund strategic voting. Okay, so this is similar to what I've shown before, but with somewhat different numbers. This show you not so much number of proposals, but actually the number of money that is flowing into social or sustainable investment. And you can see that there is exponential growth, both in terms of the number of funds and the total assets in the fund. Many funds call themselves environmental. And the question is, in a way, if you wish, if there is really, how much there is truth in advertising. And those funds, by the way, can be either passive or active. The majority of them are active, but clearly some of them are also passive funds. The SEC also pay attention and take notice of the potential problem there. For example, here investors are demanding ESG investment strategies and opportunities, but funds may not always reflect those investor preference in their voting. Addressing this agency cost is at the heart of corporate governance today. And partly this is what we're going to talk about. We're going to actually talk about those investments, and those investments, they can be done by ES families like Calvert that I showed before. So you have a family fund that is clearly defined itself as an environmental fund, and this is the fund that this is a family fund, but also a fund that are ES, or maybe some funds that are not labeled as ES. And also you have the BlackRock and Fidelity and Vanguard of the world that as a whole, the family is not an ES family, but they may have, these non-ES families may have, and they do have ES funds. What we're going to look, actually, we're going to look at those funds. And the question is that we're asking really is whether those environmental and social funds vote according to their stated objective. Voting on corporate policy has been advocated as one of the best mechanisms those investors can achieve their goals. For example, Hartons and Gallas, this is about the company as a purpose that is beyond just making profit. Why should those funds vote with their objective? Okay, I mean, this is actually a question that I was asked many times. So in fact, as also the SEC comments have shown, they have some fiduciary responsibility. If you have a fund, at least in the US, and you're saying, I'm a sustainable fund, you have a fiduciary responsibility to deliver on your promise. Second, if there is any reputation there, if you're being caught red-handed, the question, what will this do to your reputation? But there are good reasons. One of them I already mentioned, why you wouldn't do it. For example, if indeed, as we believe to be the case, that investing in true environmental effort reduces your expected return, you have incentive not to do it, because at the end of the day, the perspective on the first page, what you have is a comparison of your return to your competitors. If you look at Morningstar, if you look at Investor, what they care the most about is your expected return. And afterwards, you can come up maybe with the reason or excuses why you didn't have a high expected return. Second, and there is a large body of literature on that, is possible conflict of interest between fund objective and fund family objective. For example, let's say the fund family of BlackRock is managing the pension money of General Motors. So you can imagine that the fund family that managed the pension money of General Motors may not have or will have incentive to vote together with the management of GM, regardless of what the fund objective is. And in most families, they do impose their will. So where the conflict can come up from, they can come from the fact that some environmental funds are offered by fund family that are not ES friendly. And we are going to examine the interaction of this fund family ideology or preference and the fund goals. I think an easy way to think about it is really in terms of metrics, of 2x2 metrics, where the 2x2 metrics, you have the fund family ideology, whether it's ES or non-ES, and then you have the fund goal itself, and the fund can be an ES or non-ES. Okay, so when the family ideology and the fund goals are the same, like it's an environmental fund of an environmental family, there are no conflict there. Similarly, if Fidelity it's a non-ES family fund, offer non-ES funds, there is no potential conflict. The conflict can really arise when you have an ES fund belonging to non-ES families, and possibly also they're sort of the other way around. So let me show you here, on a slide, the main finding of what we have, and afterwards, all the rest is going to be more diving into details. So, if for the next 3 minutes, if you can give me to enjoy the benefit of the doubt that there are no identification issues, I will show you later that actually I addressed them. This is just a graphical representation of that's showing you the result. Afterward, we'll worry about all the identification. So just for 3 minutes, don't think about identification, just think about the economics behind it. Okay, so what you see here on the y-axis is the group average support, and on the x-axis is the outcome of each proposal that is coming at the annual report. So the 45-degree line is just saying that this particular group, let's say the group of Philip and the rest of finance faculty member at Monash, how do they vote on environment? How do they vote on social relative to the overall vote? Okay, so for example, here you see the line of voting for the non-environment funds, the non-environmental fund, the regular fund belong to non-ES families. Okay, and you see that regardless of the outcome of whatever the proposal here, it is not surprising that for this ES proposal, they're always below average, right? Because these are the fund that's saying, explicitly almost saying, we care about expected return. Environment is not part of our agenda. And you see it in their vote on ES type of proposal. This is not surprising, and no break here of the contract, so to speak, between the intermediary, the fund, and its shareholder. The same thing for the ES fund of ES families. You see, this is the dotted gray line, and they are voting for environmental issues much more than the average, right? Than this, sort of black 45-degree dotted line. This is also not surprising, regardless of whether we're talking here about proposal that barely pass or proposal that highly pass. Here you see here the votes, okay, the pattern of the votes as a function of whether the vote passes or not of non-ES funds that belong to ES families. And you see that already that actually the family ideology has some impact, right? You just compare the non-ES fund of ES families to those of non-ES fund of non-ES families, and you see that the family ideology sort of make a difference. But what is really interesting is actually the pattern of the votes of ES fund that belong to non-ES families. So what do we see here in terms of the pattern? First of all, we see that support for ES funds is greater than support for non-ES fund, right? This is the two gray line relative to orange line. We also see that ES funds of non-ES family vote strategically, and this is what I circle here. What I mean, do they vote strategically? Okay, when there are votes on proposal that are very unlikely to pass, right? That the average outcome is somewhere between 0 to 30%, they tend to vote more for this proposal. Okay, when there are votes that are very likely to pass, votes that are above 60%, they're also more likely to vote for it. But where they shy away from voting for the proposal is at the region where this is much more of a contentious vote, where their voting is more likely to have an impact. Now, I'm not trying to say that they have a crystal ball, they know exactly where the eventual outcome fall, but speaking with fund managers and with actually also with corporate, most of the votes, everyone has a good idea a few weeks before of where the wind is blowing. So it's not like a complete surprise you're coming. If you think about the Exxon Mobil case I brought you before, it was all over the newspaper before that this is going to be sort of a critical, contentious sort of vote, which it was. So it seemed that actually family often prevail over fund shareholders, and this is what you see here. The reason why we call this in a way greenwashing, because if you think about this ES fund can come to his shareholder and say, look, on average, we are supportive of ES proposals. Okay, and this is why it's so sophisticated, because we are supportive, but they don't tell them when it really counts, we don't support it as much. Interestingly, here I also put the line of the ISS, so you see that it cannot even be justified because ISS is not supporting the proposal. These proposals that you see, the strategic behavior, are not the one that are not supported by ISS, but really they are vote in line with their family preference when it mattered the most. And this is really the most important result of the paper. What I'm going to do now is in the few minutes that are left until Philip will tell me to stop, I'm going to actually talk about really the issues of identification and definition that are absolutely critical, and I appreciate you giving me the benefit of the doubt. So let's start probably with the first question. The first question will be, okay, but maybe this is just how these funds are behaving in general, not only for ES votes. Okay, so here we rescale it by how they vote for governance proposals. And you see exactly the same pattern. Okay, suggesting that this behavior is unique for environmental proposals. And it's not something that they vote in general like that for governance proposals. So it's already giving sort of some credence to what we do. In terms of the data, we are using here ISS data from 2018. We're now actually in the process of extending it to 2021, and we look at shareholder proposals on socially responsible investment, governance, etc. Overall, those proposals don't receive much support in general. But in terms of the fund classification, there are two classifications that I think are important for me to discuss for a few seconds. The first is the classification of the fund themselves, and we're using here actually two techniques, mainly relying on the fund name, which again, according to the SEC, fund name they cannot use the misleading name. This is the name rule. Prohibit misleading face, and we're looking for ES fund related screen like sustainability, social, responsible, impact, ESG, CSR, etc. We identified 220 funds like that. And then what we've done is actually we went and we checked manually, okay, the prospectus of all these 220 funds, and we find that all of them actually were classified correctly. But we also took a sample of another 200 funds that were classified as non-ES funds, and there we find a small number of type 2 error. That means that fund that we classified as non-ES actually were ES. Interestingly, this fund that were misclassified, all of them without exception belong to ES families. So Calvert, that is ES family, sometimes did not put it in the name of the fund because they thought that's kind of obvious. The more probably complicated, less often discussed issue is a family classification. So what we've done for most of the paper is follow the footsteps of Bolton et al. In a very nice paper that was recently published in the JFE, where they took a measure from political science about how to assess ideology, and basically saying, look, the best way to assess ideology is by looking at the votes in the Senate or the vote of a particular a Congress member, and basically see how how similar their vote is to other, and this is how to classify them in terms of ideology. They took this idea and applied also to voting of funds on social issues and governance issues, and actually we're doing the same. The calculation, by the way, is rather complicated. It's called W nominate. You can see in the Bolton paper and in our appendix as well. But what we did then, and this is something that I said, let's try to keep it simple. Let's just look at what the average support here, which is very simple calculation. You just look at the fund and say, let's see what the average, how much on average is support ES votes. The two are extremely highly correlated. You see a correlation of 96%, suggesting that maybe the very simple correlation capture most of what we did. And I really like actually this slide that's showing you how funds are being divided if you look at family ideology and the average support. And what is nice is to see where the different funds fall. So you see that Calvert and Pax World, it doesn't matter how you do the characterization, or on the left side, these are indeed the ES families. And it's not because they say they're ES, because this is how they vote. Okay, you see that State Street is at the margin, indeed also sort of ES family, and also TI Craft can be considered as more favorable to ES, again, based on their voting. Okay, despite of what the great publicity that Larry Fink and BlackRock are doing, if we look at their vote, at least between 2011 and 2018, I don't want to say anything about their vote now in 2022, but at least in our sample period, according to their vote, it's going to be a real stretch to classify them as a fund family that is sympathetic toward the environment or social issues based on their votes. Clearly, DFA, sort of fidelity, again, by both counts, can be classified as non-ES families. Okay, now what is interesting, and this is not was not done in the original paper by Bolton, is they look on in 2012. We have 8 years of data. And like what you expect from ideology, it doesn't matter which year we do it, it's really, really sticky. Okay, so it's not like fund is moving from 1 year from being categorized as ES, and another year the family fund is categorized as non-ES. It's really sort of very sticky classification, or persistent, if you will. And you see here the sort of almost like the transition metrics. Okay, so what will be the empirical strategy? Philip, I have like 5 more minutes or something like that?
Whatever you'd like, up to you.
2 hours.
5 minutes sounds good.
Okay. So in terms of the empirical strategy, what we do here is, I think, is rather straightforward. We look at the probability for voting for an ES proposal. And remember, we spoke about this sort of deep in the proposal where it's contested. So we have a variable for contested that is 1 if the voting outcome is between 60 and 40, and 0 if voting outcome is otherwise. Of course, we change it and we check for robustness. And then we have contested and ES of non-ES funds, and a host of control variable, where our denominator or the control firm are the non-ES funds of non-ES families. So we're trying here in the base regression to control for the family behavior. Intrinsic control belong to the same family. We believe it's the most natural control, even though we tried all the rest and the results are the same. So I won't talk about it for too long. You see, in terms of control, we have time varying fund and family control, proposal, meeting, family, and fund fist effect. Basically, we're able to control even if you have the same proposal in different meetings. We see if it's contested, not contested, how Fidelity or DFA or BlackRock voted for it. Okay, so you cannot even say, this is just because this is about animal protection and not about environment. We control for the proposal itself. And sort of the main result that we find is basically, you see it here in this regression, and this is going to be repeated over and over again. First, if you look at ES votes of ES of non-ES funds, we see that those environmental funds of non-ES are more supportive of uncontested ES proposal relative to those of the non-ES funds of the same family. But more important is that the differential support provided by ES funds of non-ES families shrink by almost 10% on contested proposals. Okay, that's sort of the main result that I showed you also in the chart. Okay, in terms of economic impact, it's clearly big. So on average, environmental funds of non-ES families are supportive of ES proposal, but these funds are more likely to vote with the family when it matters the most. If we look at active versus index fund, most of the action actually is coming, not surprisingly, from the active funds, not from the index funds. If we look, and here we're starting to go more and more into the weeds, funds voting on different ES proposal in the same meeting. So you have the same fund voting on different proposals in the same meeting. You see that they tend to support the one that are not contested relative to one that are contested, sort of as you can see here from this result. So it's really contested is making a sort of a huge difference, even when we include the fund by meeting sort of fixed effect. And then we look at fund voting on the same ES proposal type in different meetings. And we find, in fact, a result, again, consistent with it, whether we use ideology or the average prior support of the family, when it comes to contested proposal, even when we include the fund by proposal type fixed effect, we find that when contested for the very same proposal, they tend to support it more, support it less when it is contested. We spoke already, sort of what happened to support in the same meeting. And then we have, again, coming to the placebo test, looking at the governance proposal. Okay, are ES funds of non-ES families friendlier to management in general? And we don't find that. Okay, if anything, it's sort of going in in the other way. So it's not that we find that this is what is happening in contested proposal for governance. This is something that is really specific to ES proposals. Now you can ask, well, maybe sort of all ES funds behave like this, not only those of that belong to non-ES families, even though our chart did not show that. So what we're doing is now using ES funds of ES families as our control group. The results again show that it is really the environmental fund of non-ES families that vote in this unique way in contested proposals. And we use other control group, but again, I don't want to bore you too much with details, and I'll try also to leave some time for questions. What we find is that ES funds are more supportive of ES proposal than non-ES funds. That's actually reassuring. Okay, that's what we expect according to their fiduciary responsibility. We find that ES funds in non-ES family vote strategically. They strategically provide less support to ES proposal when their vote is more likely to be pivotal. In other words, family prevail when it matters the most, and this voting allowed them to have a voting record of high average support for ES proposal, consistent with the fund's stated goal, but at the same time, when their vote really counts, they family preference prevail. Why does this matter for us? It really matters because it's allowed them to portray themselves as ES supporter while they withdraw support when it really counts. Us as investors, we have to ask ourselves whether this is really what we want, whether this is really truth in advertising, and whether they serve their fiduciary responsibility as they are expected to serve. Thank you, and I'm happy to open the discussion to questions, comments, etc.
Thank you, Roni. That was a great talk. So I really like the broad-based talk, and I really like the punchline of the paper, like, with regards to ES funds not voting strategically in non-ES families. And I think, it's important to shine a light on this. I think it's important that your paper has done this because, I think the policy implications of this are important. And we need to, as a broader community, like academics, regulators, shine the light on what these funds are doing, because this behavior seems a little bit suspicious to me.
Yeah, I would agree. I was shocked when we find it.
Okay. Oh, so I had a couple of people raise their hands, but now they've lowered them. Please feel free to ask questions in the Q&A if you want to type your questions out. If anyone wants to ask a question using their mic, I can turn your mic on for you. So please go ahead. The conference founder actually raised his hand at the start of the presentation, Bala, but he's logged off. So I don't know what happened to him. So, okay, we've got a question from Greg Tyndall. How is the meeting FE? I presume that's fixed effects constructed.
Fixed effect, yes. What is the question? How is the meeting fixed effect what?
Constructed.
So, you have an annual meeting. So in the annual meeting, you can have 3 or 4 or 5 proposals. Okay, so every time that, sort of these proposals, this meeting come up, this is where the fixed effect is going to be 1 and otherwise going to be 0 for that. So that's how we can gauge the meeting or construct the meeting fixed effect.
Okay, thanks, Roni. Any other questions? So
if there are no questions, let me actually, if you don't mind, I'll add one more comment, if I may.
Sure, go ahead.
Look, I think, I don't have to tell all of you that this is really a hot area of research. And every time that you write a paper, literally you write a paper in this area, there may be 5 other groups around the world that work on the very same topic, not because they're copying from you, but simply because many smart people are thinking now about these issues. But I think that there are 2 issues that we are, I don't want to say ignoring, but that we're not putting enough emphasis on. And the first one, which is absolutely first order importance, is really how to accurately measure firm environmental impact or social impact. Okay, there are 4 measures that are currently available, but amazingly, the correlation between these measures is very, very low, suggesting that there is something that we're not either calibrating right or we're putting completely different weights on various aspects, whether it's carbon, plastic, chemical pollution, etc., or that we don't know how to measure it. And I think before we go to try to impose, like, let's say what the SEC is trying to correctly impose, some reporting requirement, the question is what to report, how to measure it. So I think this is absolutely critical, and this is where finance people can actually join forces with some environmental scientists and maybe come up with with a good measure. We also have to remember, when you think about this measure and how to apply it, not to throw the baby with the bathwater. With all the criticism of BP and ExxonMobil, I don't think that any one of us would want tomorrow to live in a world where oil and gas are not allowed to be used. That's going to be pretty miserable. So we have to find also this balance of how you balance the economic and the impact of environment and what exactly you want to impose, both within industries and across industries. And the second issue, or the third issue that I think is absolutely critical, is how to assess whether and what firms and funds say that they do relative to what they really do. And that's also and that's what, in a way, the SEC is trying to to assess with the proposal for regulation, but that still has some way to go. So I would really encourage you guys to think about it and come maybe with a clever way of measuring E and S and measuring what firms are doing. I think it's first order importance.
Thanks, Roni. Well, we've got a few questions coming in, but I just quickly to respond to that comment. It actually follows on very much from the panel discussion we had yesterday on environmental finance. So on that panel discussion, we had a couple of people who work in, the ES funds management space as consultants and so on and so forth. And one of the things that came out of that panel was the amount of gamesmanship going on by funds to measure themselves against what they feel is the best benchmark for them to have, to sell themselves as ES in the best fashion. So some of them will measure themselves against Sustainalytics, some of them will measure themselves against other providers. And you've got this wide array of providers out there. And then I suppose then it's no surprise that when it comes back to us as academics, it gets messy. So it's actually a really nice follow-on to our panel yesterday.
Cool. I think that it's something that that also practitioners are dealing with. In fact, just this morning I was in a meeting where actually I heard about a startup that was able to raise $30 million just because they are trying to come up with assessment of what really funds and companies are doing. We'll see if they'll be able to do that with AI, of course. Everyone has AI in the title now.
Oh, of course, yeah. Okay, the chat has actually warmed up. So would you prefer if I read them out to you, or do you want to just open it up yourself? It's up to you. So
let's see if I see them. I'm not sure I see them, actually. I see only from you for some reason.
Okay, all good. I'll read them out. So this is actually one of my colleagues, Arseny Benko.
Okay.
He's asking, are there any differences in voting patterns across different types of ES funds from non-ES families?
Any difference in the voting pattern across different type of ES funds? Okay, so that's a great question that we didn't directly look at, and I presume that what the question refers to, whether you have ES fund that concentrate more on the environment versus social. That's
he's actually followed this up. He says, I mean, for example, ES funds that have something about ES in their investment objective versus ES funds that are, say, PRI signatories, so, or whatever perhaps you were referring to as well.
So we didn't find sort of the difference between the fund that more categorizes E versus S, but there may be more delicate intricacies where you do find it. I think that the follow-up question, I see also the follow-up. I think that another follow-up question for this that is also can be relevant is whether we find consistent difference across the ES families. Okay, and this is a question that actually we're trying to look at, because this is really fascinating question, coming back to how the voting between different funds are being determined. Okay, within the family. That this is a separate issue that we have to look at. But this is a good question. Arseny, I promise that I'll come with the more informed answers in a few days directly to you. I'm just writing it down.
Okay. I'm pretty sure I can save this chat for you.
Okay, so if you can save, that will be super.
Cool.
Okay, then I see another question. Given that the ESG fund belong to non-ESG family, do not walk the walk. Then in terms of risk-just performance, do those funds basically perform better? That's another great question. We didn't look at the performance, but that's in a way an obvious next step, which is what is the performance? Okay, we're basically, if this is their incentive, do they achieve the goal? But you see, I think that the problem with just looking at this is that if we talk about, this is one possible outcome. Another possible outcome simply they're doing it because the family wants to vote in a specific way for other reasons. But having said that, I think that this is something that, so we should be prudent and directly check what is the performance. Thank you.
There's one more question, Roni.
So this question, I see only the first part. Okay, here it is. Okay. Our CO2 reduction diversity proposal with getting high support. So actually interesting, Tina, sort of the CO reduction, at least in, we didn't see that they get a lot of, there aren't a lot of proposals about CO2 reduction, at least then. Now in 2021, 22, things have changed. The diversity proposal actually are the one that's getting a lot of support. If you think about which proposal are getting sort of the support.
Does anyone else have any questions? Please feel free to raise your hand or put them in the chat box. So we've got a couple more minutes. I had one question, Roni. I mean, like you alluded to it with the Exxon. I mean, like, you know, absolutely believe the punchline. But what I was thinking when I was reading your paper, and again during the talk today, is how do these funds realize when a vote is going to be contentious or not? Like, where is the information coming from? That to me is, you know, yeah.
That's a great question, and you know, sort of, we thought about it, and what we started to do actually just 2 weeks ago, we started to interview, you know, a few fund managers. So we already spoke with the guy at BlackRock that is in charge of the voting. So first, just by way of background, if you think about the family fund, each family fund has sort of philosophy of how it allowed the diversity of voting that it allows. So most funds start with the null, so to speak, is the fund family votes in lockstep. So they do not allow the fund themselves actually to have too much leeway. Now, of course, when they talk to you, they'll tell you, yes, other than extreme cases, then there are always exceptions. And if you have a fund manager that is very successful and have strong opinion, probably they will let her do whatever sort of she decides to do. But what, at least from the conversation with the two that we already spoke, it seems like there are firms that are, you know, sort of basically looking for proxies, and even a month before, once an item is being put on the ballot, which is happening not at the day of the annual meeting, but several months before, there is already some indication through the fact that some of the votes are coming in writing, and then there are discussions with management. And what we are told that almost always, not always, but almost always, when there are votes that are going to be contentious, sort of they know, or going to be close, they know about it.
Yeah.
Not always, but that's a good question. I mean, like, so we are now in the process of actually talking with several more, so we can come at least, not only we spoke with 2, but we spoke with 6, and see if we get a sort of consistent result and sort of report that.
Okay. So is there anything you'd like to say to finish up, Roni? Because it's 10 o'clock, otherwise we can wrap up, or?
I think that I really appreciate sort of really good questions, and I enjoyed giving it, and hopefully next year in person. Yeah,
that'd be great. So thank you so much, Roni. Thank you for giving the keynote. Thank you for a great speech, the broad-based speech and the paper-based speech. And yeah, hopefully next year this conference will be in Wellington and we can meet in person and have a bit more fun.
Absolutely. We would love that.
Thanks, Roni.
Thank you very much.
Okay, bye, everyone.